insetting is a legitimate way to decarbonise supply chains. It's an appropriate thing to do, but it must be delivered in a fair, transparent and high integrity way. And there is, a necessity to think about that from the start. We don't want to kind of have to be going back and fixing issues. We just want to start from a good level.
Welcome to Scotland Matters. I'm Eleanor Kay, Senior Policy Advisor, and I'm joined by Laura Ferrier, who is our Policy Advisor on Natural Capital. And today we're discussing a topic that's become increasingly important for Scottish agriculture and land management, and that is insetting. So you might have heard terms like Scope 3 emissions, supply chain decarbonisation, or carbon reporting. Increasingly, these concepts are finding their way onto farms and estates through contracts, sustainability programs, and bio requirements. In this first episode, we're going back to basics to explore what insetting is, why everyone's talking about it, and what does it actually mean for farmers and land managers. So, Laura, start with an easy one. What exactly is insetting?
So insetting is when emissions reduction activities are delivered within an operation to balance emissions from that operation's activities. So these could be reduction, abatement or sequestration activities, essentially actions to reduce the carbon footprint of that operation. Insetting can then occur at a larger supply chain level, where a supplier reduces their carbon footprint, which in turn reduces the carbon footprint of the buyer.
And how is that different from offsetting?
So insetting is related to offsetting. It's a lot of the same activities, but in the case of offsetting, emissions reductions occur outside an operational supply chain and the outcomes are bought in. So someone else, somewhere else, is paid to reduce, abate or sequester emissions to balance the emissions released by the offset purchasing entity. So it's more about kind of location of the activity in relation to the supply chain.
So is the supply chain sort of suddenly interested in this? Or has this been a sort of gradual development that's sort of only recently got down to the farm gate?
Yeah, so a bit of a mixture of both, really. We're seeing increasing demands on supply chain actors, particularly large entities, to disclose and report on their impacts, whether that be climate impacts or we are starting to see nature impacts come in as well. So we are starting to now see these cascade down the supply chain. It's definitely a kind of an area of development. So there's lots of international standards being developed for these kind of reporting standards, and the UK are starting to adopt these as well. A lot of these standards are voluntary at the moment, but we're definitely seeing them move globally to move towards kind of compliance reporting. So I think that's why we're starting to see these agreements creep in as it comes down the supply chain.
So when we hear things like Scope 3 emissions, what is it, and why should farmers care about this kind of Scope 1, 2 and 3 emissions?
Yes, so there's lots of different terms floating around. So if we kind of break it down, Scope 1 emissions are direct emissions from activities. So this might be emissions from fuel use in machinery, livestock emissions, or from gas used in cooking. Scope 2 and 3 are indirect emissions. So Scope 2 are indirect emissions specifically from energy use. So think about emissions related to electricity use, really. Scope 3 emissions are the most complicated because they are emissions that occur upstream or downstream of an operation. So upstream emissions might include things like input manufacture, and then downstream emissions include things like waste management, things like employee commuting and all that kind of come in here as well. So these are much harder to account for because they're kind of not directly produced by the reporting entity. So these kind of Scope 1, 2 and 3 emissions are at an entity level. When we think at a supply chain level, then a farmer would be part of the Scope 3 emissions of a buyer, such as a processor or a retailer. So, for example, thinking from the retailer perspective, their Scope 1 emissions might include fuel used in warehouse machinery. Their Scope 2 emissions would then be electricity on the shop floor. but then a significant amount of their Scope 3 emissions will be from their suppliers. So if a farmer then reduces their Scope 1, 2 or 3 emissions, this would reduce the Scope 3 emissions of the buyer, resulting in everyone's carbon footprint reducing. So this is where we kind of look at insetting as a way to reduce those supply chain emissions, focusing on the Scope 3 emissions of the buyer or kind of all of the emissions associated with the supplier.
So is it the very nature of those being sort of somewhat out of the control of the sort of the ultimate reporter? Is that why agricultural emissions are sort of becoming more important in corporate reporting?
Yes, in a way, I think in any carbon footprint, Scope 3 emissions are usually a really significant part of the overall footprint. And it's especially the case for agricultural emissions. And often they are fairly poorly understood by reporting entities, but often simply for the fact that they're produced elsewhere. But also, an entity may not necessarily know what's going on in their supply chain. But I think the other key part of this, and what makes it appealing for buyers, is that there are lots of activities that can be undertaken and changes that can be made to reduce those emissions from agricultural supply chains. And I think also a significant area as well is thinking about risk and resilience. So agricultural supply chains are very exposed to climate change impacts. And so therefore buyers investing in their supply chains can improve their resilience to impacts and ensure that they secure ongoing supply. I think the other key area that we see, even just more widely in carbon markets, is about the avoidance of double counting or greenwashing. So reporting entities and corporates want to make sure that any reporting that they're doing and any action that they're taking is high integrity, and they're not claiming carbon reductions that have already been accounted for. So I think all of these kind of factors come together and make these more important. We are also seeing new kind of standards emerging. So in the carbon accounting space, we have the Greenhouse Gas Protocol, and in the target setting space, we have the Science Based Targets Initiative. And these are kind of the two major international bodies that set targets in these areas. And they have their kind of wider corporate standards, but this year we've seen both release their kind of land-based sector standards. So we are starting to get into the real nitty-gritty of understanding the kind of intricacies that relate to these agricultural and land-based supply chains.
So moving away from the sort of standards and the sort of higher level aspect of things, when we get this down sort of on the ground activities and impact, what sort of activities and changes might qualify as insetting for a farmer?
So we might have emissions reduction activities, so reducing your carbon footprint, for example, through reducing fertilizer use, reducing fuel use or use of sustainable fuels, using renewable energy, reducing inputs, improve nutrient management or livestock efficiency improvements. We might see emissions abatement activities, so this is kind of stopping the release of greenhouse gases. So a key one here is peatland restoration. And then we could have emissions removal or sequestration activities. In a farm context, this might look like tree planting, improving soil health, planting hedgerows or wetland restoration.
Would you say farmers are probably already doing some of these things that would look very similar to the kinds of activities and changes that we want to see, possibly as we sort of transition to the new schemes that we've got?
Yeah, absolutely. I mean, a lot of these things are just good for business in terms of resilience and efficiency, or equally are being funded through government rural support payments. So these are things that may already be familiar. And for some people, it may have been part of their operations already for a long time. As the climate changes, farming practices are changing and new risks are having to be managed. For example, a key challenge that we're seeing is dealing with water, whether that's too much at some points during the year and not enough at others. And many of these interventions support with water management on farm. So it's not all about carbon. There are lots of other benefits that we can talk about later of these activities. So farmers, of course, may already be doing these things or maybe thinking about doing them in future.
So is there a chance that we can, in a sense, get sort of necessary things paid for already? But sorry, I'm going to stop. That was not a question I wanted to ask. That's a later question. We'll stop that there. So when we're sort of being approached perhaps by processors or retailers or those sort of further up the supply chain, what sort of changes might they be asking for? Are they going to be very specific to the product that they intend to purchase, because that's directly linked to the sort of scope 3 aspect of the emissions? Or is there a chance they're sort of more broader?
Yeah, I think we're probably at this stage looking largely at emissions reduction activities. So these could be things like reducing fertilizer use or precision application, things like cover cropping, reduced tillage, using different inputs, maybe changing varieties, looking at manure management or practices to improve soil health. So essentially it's looking towards moving towards what we would describe as, I suppose, regenerative agriculture, where we're supporting nature, which will in turn support us to farm sustainably. And I mean sustainably both in terms of environmentally, but also economically. And as I said, kind of thinking about those risk and resilience frames as well.
When we think about the sort of participation of farmers in these sort of changes in activity and reduction activities, is that participation likely to be more voluntary, or are we seeing a growth in sort of mandatory expectations?
Yes, so ultimately it's going to depend on the contract that you sign. In basic terms, it will probably look like making changes to your farming practices and also being required to collect on various pieces of data and reporting on those. I think if you were being asked to reduce your emissions, the requirements would be very different than if you were being asked to sequester carbon. So, for example, a reduction in fertilizer use would be relatively simple to account for, as your carbon footprint would decrease by the volume of the fertilizer avoided multiplied by its emissions intensity. Whereas if you were being asked to sequester carbon in soil, for example, there would need to be much more extensive monitoring, reporting and verification to actually quantify the volume of carbon stored. So I think those agreements could look very different. In terms of whether they're voluntary or compulsory, theoretically, yes, they're voluntary. You could decide not to sign and you could sell your products somewhere else, or some suppliers or some buyers, I should say, may be saying, yes, you could choose to do this or you can continue on. We're not the buyer. We don't know what all the buyers are asking for. So at this stage, I think it is voluntary in most senses, but I think we can expect to see these practices becoming more common and more required and seen as the baseline. So it could be that in future, a kind of requirement of participating in supply chains is that you implement these practices as a baseline.
And do we think that a company's sort of preferring to invest in their sort of own supply chain decarbonisation rather than offsetting things elsewhere?
Yeah, so from my perspective, insetting is a very sensible decision, because when you are offsetting, you're buying a carbon outcome that has occurred elsewhere. Now, when anyone takes an action to reduce their carbon emissions, that activity has a global impact. It's not necessarily an individual impact that is felt by that person who's undertaken that activity. However, a lot of the co-benefits of taking these actions are felt on an individual level. So, for example, if you're improving your soil health, which maybe does reduce your carbon emissions, there's going to be benefits on crop yield. There's going to be benefits for water retention. You might be able to save money on fertilizer and input costs. And those benefits are felt individually. So if you're investing in insetting, you're making sure that all of those co-benefits are retained in the supply chain rather than being elsewhere. As I mentioned earlier, it's also about resilience. If your suppliers then are experiencing all these co-benefits and are developing more resilient operations, as a buyer, you're thinking, okay, well, these suppliers are more likely to be able to continue to supply me with high quality products and services in the future. So it makes business sense as well.
So we talked about those sort of benefits that could exist and likely do exist for farmers. We know that Scottish agricultural policy is definitely pushing towards this shift towards sustainable and regenerative practices. We've got the sort of gradual introduction of the new tiered system, and we've seen the launch of the Code of Practice for Sustainable and Regenerative Agriculture, along with the Rural Support Plan, and a albeit somewhat slow move to the new policy, but a relatively clear direction from Scottish Government as to what they want to see from the farming sector. Would you say that the benefits to farmers beyond just this carbon reduction angle, do you think they're clear enough to farmers? And do you think they're communicated clearly to farmers?
Not necessarily, no. I think there can often be quite a narrow focus on carbon outcomes because potentially that's what's being reported on, without acknowledging those wider benefits. And I do think that this could change as we see particularly kind of nature impacts coming into corporate reporting standards. But on a kind of farmer level, a lot of these co-benefits are probably more directly appealing than the carbon outcomes. So, we don't want to lose sight of these. These decisions need to be balanced and they need to take a holistic view. We don't want to prioritise carbon at the expense of other things like business viability or biodiversity or water management, these sorts of things. So I do think that these co-benefits do need to be communicated better, and potentially some of the risks of participating as well.
Do you think it's the responsibility of the supply chain to do that communication, or do you think this is something government could correct in how it communicates around the sort of the rollout of the new policy?
I think it's a bit of both. I think if you are a buyer and you are requiring your supplier to do something for you, it is your responsibility to communicate why and what those potential impacts are going to be and what the options are. So that's something that we're really kind of key on is looking at free, prior and informed consent. So there is a responsibility there. But equally, I do think that there is a responsibility in government because, as you say, it's kind of across so many areas of policy and it covers so many outcomes that government want to see, and agriculture is it's just vitally important to our survival and to life and to achieving so many of these outcomes that we want to see, that they do need to bring people along on that journey. It needs to be in partnership with farmers, and we need to be discussing with farmers what they need, what they want, what's going to help them grow and continue. So I do think it's an obligation kind of across the various actors.
Yeah, completely agree. I sometimes think we forget the sort of natural human behavior when you're told to just do something, that sort of natural desire to somewhat rebel or question when you're not given enough information. And I think we fall into that trap quite frequently when we talk about sort of moving to new policy. It's very much no, just do it. That's what we're telling you to do, and it's it never kind of invites eager uptake. Is there an opportunity, do we think, that farmers could actually gain access to sort of new funding, whether that is different streams of funding from the government or funding for sort of transition support to these new systems from elsewhere in the supply chain or also financial services?
Yes, in theory, yes. And I think that this is where we need to be careful because best practice is that farmers should be compensated by buyers for their decarbonisation efforts, and buyers should be working with their suppliers to make these changes that will benefit the whole supply chain. You know, there could be a future where these practices are just seen as baseline, so accessing this finance now when it's available can support farmers to deliver these new interventions, especially where capital investment is required. And I think also this is where government can come in as well, because government are very clear that, you know, public funding is limited and will likely decline in future in many areas associated with nature-based policy. And they're wanting to see more private investment. So government needs to be clear in the agricultural space, should this private investment actually look like? Because if there's no guidance, buyers are also just finding their way. They're figuring it out themselves. And that could be a real missed opportunity to encourage investment in this sector. Of course, this does all sit alongside other funding. So as you mentioned, there are kind of lots of government policies and initiatives that are encouraging regenerative agricultural practices. So inevitably there will be some sort of mix of public and private funding. But that's why I do think it's important that we do set out more structure in this space. Otherwise, you know, we'll get a few years down the line and we'll realise actually we missed a really significant source of investment, and now it's kind of going to cost even more.
So say I'm a farmer and I'm approached about one of these sort of insetting agreements or reduction agreements or whatever sort of we sort of bypass the whole sort of jargon and language barriers that do exist in this area as well. But what kinds of things should farmers be sort of considering or aware of when sort of faced with these quite interesting looking agreements?
From my perspective, there's lots of things to think about, but there are some questions that if I was going to sign an agreement, I would be asking myself. So thinking about, what do you want to achieve with your carbon outcomes? Because if you want to be able to sell them, entering into an insetting agreement is not necessarily going to be the way to do that. You might also want to think about what you need data for. So we are seeing increasing requirements for farmers, especially if they're claiming kind of basic payments, that they need to be collecting and reporting on certain data. So if you have to report in specific ways, that's also something to consider, because if you've got an agreement that's asking you to report in an entirely different way, you're going to be doing the same work twice. So thinking about those impacts there. Similarly, you need to be thinking about whether you have the resources, capacity or capability to deliver these things, and if there's any support or kind of professional development that's needed there, or any advice that you might need to seek. And whether the contracts allows you to access this. So you might have some contracts that involve kind of an upskilling element, and that could be really valuable to you. You also need to think about how much it will or would cost to deliver the interventions, and does the contract clearly cover this? If you're going to be asked to do a lot of things and you're not going to be paid to do them, you might be kind of looking at the balance sheet and thinking this doesn't quite make sense. Equally, you also might want to consider whether your yield is going to be affected. Some of these practices can have a kind of transition period where there might be an impact on yields, or inevitably, if you're changing practices, again, that could have risks. And does the contract provide adequate protection against this? You also might want to think about the contractual term as well. So depending on the length of the contract or the type of outcome that you're being asked to produce, how long are you committing to this action for? Is there a dispute resolution mechanism in the contract? So if these interventions do cause unintended consequences, or things change and you need to be thinking about changing the contract, is there a way for you to raise and resolve this? And equally, I think it's also important to think about whether the contract interacts with any payments you're receiving or plan to receive, such as agricultural support payments, or again, whether you're committed to already selling credits to someone, or whether that's something you would like to do. You know, signing these contracts could make kind of accessing those sort of payments harder. And then there's kind of more complicated questions around how these kind of contracts interact with things like insurance, succession planning, tax treatment, land value, and those are things that more widely we still don't necessarily have clarity on, but might be important to consider.
It feels complex, but there's potential routes there to actually make this work in your favour as a land manager and farmer to help improve resilience, especially for climate change resilience, but also that broader ongoing business viability, which is is increasingly a concern for farmers and land managers. I suppose there's lots of questions as to when we look at things like data and the complexity of data collection, it does feel like there are easy routes to deliver this, and especially when we look at data collection, there are lots of very credible sort of methods in which you can collect good data across different platforms, but they're equally useful regardless of the platform. Do we think sometimes the rush to be seen to be doing this within the supply chain means we end up with sort of duplication of effort rather than a sort of sensible approach to make sure that this is data that is most useful across multiple platforms, and therefore it can be used by everyone, whether that's government reporting or your audit trail for your red tractor or your leaf mark, or are we perhaps not pushing back as a sector enough on those kind of data agreements?
Yeah, absolutely. I mean, there has been a real proliferation of platforms, as you would expect. But I think we've got to remember that in a Scottish context, if you are kind of claiming basic payments, you are now required as part of the whole farm plan to undertake a carbon audit. And there are 4 platforms that are acceptable to use to deliver that carbon audit. And I do think that buyers need to be aware of this because, the suppliers are being asked to use these platforms and are likely going to be familiar with these platforms. So I think that is a key consideration. I do completely understand that as a buyer, you might want your data in a different way, or it might be useful to you in a different way. You might want more information, you might want less, you might want more kind of disaggregated information. It's really challenging, and that is just a challenge more widely in kind of emissions accounting and reporting. So there does need to be some sort of balance there. I think also what's really important to acknowledge is that actually in sustainability reporting standards, such as the kind of UK sustainability reporting standards, they are very clear that data collection should be proportionate, and it's also appropriate, kind of based on the capabilities and capacities of those collecting that data. So that applies at a supplier level to kind of what they're doing, but they also need to think about that when they're asking third parties for their data. They need to consider it at that third party level. And actually a farmer may not be reasonable to request that they collect a certain level of data, because that data collection could take months and it could cost a lot of money, and it may involve kind of new platforms, and there needs to be upskilling there. So there does need to be this balance of actually it might not be necessary to collect every single data point you can possibly find. Think about what's really needed. And also it might just be that capacity building over time. It might be in year 1, you actually go for a really basic baseline. Then in year 2, you do a bit of upskilling and capacity building, and we add kind of more bits here and there. It doesn't need to be an all or nothing approach. We can build up these data sets over time, and inevitably you do need to collect data over time. Like a single data point, it tells you what's happening there and then, but we need to collect this over time. So it's really complicated, but we do need to acknowledge that there is agricultural policy in Scotland that is requiring certain things of farmers, and I do think that insetting agreements need to be sympathetic to that. And equally, if you are saying, actually, we do need you to use this other data platform, are you compensating for the time that farmers have to spend doing that rather than doing the actual work of kind of being out and farming. You know, when we're talking about compensation, it's not necessarily just paying for the intervention, it's paying for everything around that intervention that allows that intervention and that data collection to occur.
Yeah, I think that ask of sort of proportionality in terms of data inputting required for the actual task involved it can get lost somewhat in the enthusiasm for having something to report as a corporate entity, and it feels like the sort of thing that we are seeing within sort of the sort of Scottish Agricultural Data Partnership, that is the sort of thing we are concerned about and keen to ensure that the data stays within the control of the farmer as much as possible. But if we're looking at the need to extract ever more complex, nuanced data sets, actually that farmers have the skills to also utilize those to help on-farm decisions, because data can be incredibly useful, and we do need to use it far more as sort of standard across the sector. But you having to log data into a system without the tools to utilize it for your own decision making doesn't create farmers keen to support to catch data. All it does is add another list of jobs to do without perhaps the clarity of the benefit. Do we think it's going to be, or how do we make sure farmers understand how the sort of compensation is being sort of captured or delivered? Is this something that just gets kind of rolled into the standard commodity price, or how do we make sure that they are aware of what the extra stuff has been worth?
So I think this is really challenging because there is no standard for this, which is one of the reasons why insetting agreements may generate issues. So if we look to kind of best practice, the Science Based Targets Initiative, which, as I said, was the international standard for setting net zero targets, recommends that buyers should provide yearly contributions to the upkeep and continuation of carbon reduction interventions. So essentially following a kind of payment for ecosystem services model. This is also key because it demonstrates causality. By paying for the outcomes annually, the buyer is clearly signalling that the carbon reduction is due to their investment. And so it makes it a lot kind of clearer that they can claim insets from that. The Science-Based Targets Initiative also recognise that the payments really should correlate to carbon prices, such as those in the domestic carbon market. So in other words, buyers could pay farmers what they otherwise would have received if they sold their carbon on a kind of wider voluntary carbon market. And this could look like looking at, if there's no kind of compliance market mechanism, it can be looking at the voluntary carbon market, looking at the price of nature-based ex post removal credits. So, for example, in the UK at the moment, we have the Peatland Code and Woodland Carbon Code, and if we look at, on average, prices are approximately £25 per tonne of carbon sequestered. So, a buyer could look at kind of that as a pricing mechanism. I think at a bare minimum, they need to be paying for the cost of the intervention. And as I mentioned earlier, not just the inputs. So, okay, you're doing cover cropping, here's money for the seeds, but it also needs to be the time and the operational costs associated with doing that. You know, if you're putting down a cover crop, there's going to be potentially fuel use to kind of lay that cover crop. It might be that there needs to be some upskilling or kind of research done. So I think that payments and compensation should cover that as well. As I mentioned, it may also be key to consider risk and yield penalty. So if an intervention does cause a reduced yield, how is this compensated for? Because if you've just been paid for kind of input costs and your yield then reduces, you have less product to sell. So whilst, yes, you've been paid to, you know, potentially buy some other seeds, you've now got less of a product. So your balance sheet is going to show a negative there. So I think those are some of the things that we do need to consider. It is complicated. As I said, there's no set requirement for how these agreements should look. So it's unclear whether it should be kind of a premium or whether it should be a separate payment or kind of rolled together. We don't necessarily have a standard for this, and this is where government, I think, needs to show some leadership here in making sure that these agreements are fair, before it just becomes a kind of, well, if you want to sell to us, you need to do it. We need to be, as I said, taking this opportunity to ensure that adequate finance is being put into supply chains, because otherwise governments will have to continue to finance that gap. And if we want to be reducing public funding, we need to make sure that the private funding is adequate.
So it feels sometimes that there's a risk for both farmers and actors within the supply chain, that these contracts are potentially being signed without either party fully understanding the long-term consequences of what they're sort of agreeing to. But is there also a risk, or perhaps it is a risk, that we will see these new activities sort of become the baseline standard in what's expected of management throughout Scotland, but also throughout the UK, and so the justification for a premium perhaps disappears in time?
Yeah, I mean, absolutely. When we look at the direction of policy as a society, we are needing to decarbonise. We're needing to meet the kind of carbon budgets and statutory climate targets. So we know the direction of travel, and the direction of travel is that across all sectors, we're having to take steps to reduce carbon footprints and to reduce carbon intensity. So absolutely, if we're looking at kind of 5-10 years down the line, this may be the accepted way to do things, similar to potentially things like animal welfare standards and other agricultural practices, or not using certain chemicals. It becomes the norm. So it is important that we acknowledge the costs associated with moving to that new normal, and for suppliers to think, actually, if there are costs and there is finance available now, as long as the agreements are fair and reasonable, this could be a really great opportunity. And actually, as you say, if you wait too long, you might turn around and think, actually, I don't have as many options now, and where's that investment going to come from?
Yeah, it's a difficult one to sort of balance that. Don't rush into these things, but equally don't rest on your laurels and watch that money, potentially that pot of money, sort of perhaps diminish. And that is, we will move on to in part 2 of this podcast, that we've been doing quite a lot of work on this to work out that there's clear things we need the supply chain to sort of start to do and be much more transparent on. But there are also lots of things that government must make clearer signals on to try and address the many questions that do still exist. But it does feel as though this is not something we can watch in the sidelines, but potentially has a great opportunity to help businesses prepare for or adapt and mitigate the impacts of climate change, water scarcity, global market fluctuations for input costs, big considerations for farmers and food producers. Potentially this is a route to somewhat de-risk it, provided we could get those agreements to be appropriate and fair for both sides. We're coming to the end of part 1, but if our listeners were to take away sort of 3 things from today's discussion, what do you think they should be?
I think the first is that insetting is a legitimate way to decarbonise supply chains. It's an appropriate thing to do, but it must be delivered in a fair, transparent and high integrity way. And there is, a necessity to think about that from the start. We don't want to kind of have to be going back and fixing issues. We just want to start from a good level. The second thing is, and we will talk about this more in part 2, is that buyers should be securing free, prior and informed consent to claim supplier carbon outcomes, and they should be providing fair compensation for this. You are asking people to do something for you. They need to be compensated for it, and they need to be able to seek advice about the contracts they're signing. They need to be able to ask questions. They need to be able to there needs to be a discussion. It needs to be a partnership. And then finally, I think the key thing is that this is an emerging area of practice. So farmers do need to consider how to make it work for them and what the risks of participation are. And also government, as we've said, needs to kind of take a lead here and kind of linking back to point 1, make sure that these are fair, transparent and high integrity practices rather than just leaving it to the private sector to kind of figure it out for themselves and regulate themselves.
Great. And Laura, for SLE members, you've produced some really useful information sheets to help further address some of these questions. Which ones have you produced?
So kind of in this area, there are a few to have a look at. We have more general information sheets about assessing your carbon footprint. So we have an information sheet for land-based businesses and then for non-land-based businesses on how to undertake a kind of carbon audit, carbon footprinting assessment. We then have an information sheet that delves a bit more into scope 3 because totally understand that that's an area that there's much less clarity on, but there is guidance out there on how to assess kind of scope 3 emissions. And then finally, we also have an insetting specific information sheet that members can access that walks you through kind of the basics of what insetting is, things to be thinking about and standards that you can be looking for. So when you're getting an insetting agreement, you can be asking, well, if you're claiming to be, say, a B Corp or your greenhouse gas protocol aligned, these are the things that you can expect to see in an agreement. And those are kind of some of the things you should be looking out for.
Great, thanks. And in part 2 of this podcast, we'll be joined by Jeremy Moody of the CAV to discuss why SLE coordinated a group of farming and land management organisations to write some open letters to both the supply chain and the government across the UK, and we'll dig into the sort of responsible actions a little bit more. So we'll see you in that episode.